you have to take steps to protect yourself. To reduce slippage, trade liquid markets and avoid thin and fast-moving markets. Go long or short when the market is quiet. Use limit orders. Buy or sell at a specified price. Keep a record of prices at the time when you placed your order and have your broker fight the floor on your behalf when necessary. Slippage and commissions make trading similar to swimming in a shark-infested lagoon. Let us compare an example from a broker's sales pitch to what happens in the real world. The party line goes like this. A contract of gold futures covers 100 ounces of gold. 5 individuals buy a contract each from someone who sells 5 contracts short. Gold falls $4, and the buyers bail out, losing $4 per ounce or $400 per contract. The intelligent trader, who sold 5 contracts short, covers his position and makes $400 per contract for a total of $2,000. In the real world, however, each loser has lost more than $400. He paid at least a $25 round-trip commission and was probably hit with $20 slippage coming and going. As a result, each loser lost $465 per contract, and as a group, they lost $2,325. The winner, who sold 5 contracts short, probably paid a $15 round-trip commission and was hit with $10 slippage coming and going, reducing his gain by $35 per contract, or $175 for 5 contracts. He pocketed only $1,825. The winner thought he made $2,000, but he received only $1,825. The losers thought they lost $2,000, but in fact they lost $2,325. In total, fully $500, $2,325 minus $1,825, was siphoned from the table. The lion's share was pocketed by floor traders and brokers who took a much bigger cut than any casino or a racetrack would dare. Other expenses also drain traders' money. The cost of computers and data, fees for advisory services and books, including the one you are reading now, all come out of your trading funds. Look for a broker with the cheapest commissions and watch him like a hawk. Design a trading system that gives signals relatively infrequently and allows you to enter markets during quiet times. Individual psychology. Trading appears deceptively easy. When a beginner wins, he feels brilliant and invincible. Then he takes wild risks and loses everything. People trade for many reasons, some rational and many irrational. Trading offers an opportunity to make a lot of money in a hurry. Money symbolizes freedom to many people, even though they often do not know what to do with their freedom. If you know how to trade, you can make your own hours, live and work wherever you please, and never answer to a boss. Trading is a fascinating intellectual pursuit. Chess, poker, and a crossword rolled into one. Trading attracts people who love puzzles and brain teasers. Trading attracts risk-takers and repels those who avoid risk. An average person gets up in the morning, goes to work, has a lunch break, returns home, has a beer and dinner, watches TV, and goes to sleep. If he makes a few extra dollars, he puts them into a savings account. A trader keeps odd hours and puts his capital at risk. Many traders are loners who abandon the certainty of the present and take a leap into the unknown. Most people have an innate drive to achieve their personal best, to develop their abilities to the fullest. This drive, along with the pleasure of the game and the lure of money, propels traders to challenge the markets. Good traders tend to be hardworking and shrewd. They are open to new ideas. The goal of a good trader, paradoxically, is not to make money. His goal is to trade well. If he trades right, money follows almost as an afterthought. Successful traders keep honing their skills. Trying to reach their personal best is more important to them than making money. A successful New York trader said to me, "If I become 0.5% smarter each year, I'll be a genius by the time I die." His drive to improve himself is the hallmark of a successful trader. A professional trader from Texas invited me to his office and said, "If you sit across the table from me while I day trade, you won't be able to tell whether I am $2,000 ahead or $2,000 behind on that day." He has risen to a level where winning does not elate him and losing does not deflate him. He is so focused on trading right and improving his skills that money no longer influences his emotions. The trouble with self-fulfillment is that many people have a self-destructive streak. Accident-prone drivers keep destroying their cars, and self-destructive traders keep destroying their accounts. Markets offer unlimited opportunities for self-sabotage as well as for self-fulfillment. Acting out your internal conflicts in the marketplace is a very expensive proposition. Traders who are not at peace with themselves often try to fulfill their contradictory wishes in the market. If you do not know where you are going, you will wind up somewhere you never wanted to be. Trading psychology. Your feelings have an immediate impact on your account equity. You may have a brilliant trading system, but if you feel frightened, arrogant, or upset, your account is sure to suffer. When you recognize that a gambler's high or fear is clouding your mind, stop trading. Your success or failure as a trader depends on controlling your emotions. When you trade, you compete against the sharpest minds in the world. The field on which you compete has been slanted to ensure your failure. If you allow your emotions to interfere with your trading, the battle is over. You are responsible for every trade that you make. A trade begins when you decide to enter the market and ends only when you decide to take yourself out. Having a good trading system is not enough. Most traders with good systems wash out of the markets because psychologically they are not prepared to win. Markets offer enormous temptations, like walking through a gold vault or through a harem. Markets evoke powerful greed for more gains and a great fear of losing what we've got. Those feelings cloud our perceptions of opportunities and dangers. Most amateurs feel like geniuses after a winning streak. It is exciting to believe that you are so good you can bend your own rules and succeed. That's when traders deviate from their rules and go into a self-destruct mode. Traders gain some knowledge, they win, their emotions kick in, and they self-destruct. Most traders promptly give their killings back to the markets. The markets are full of rags to rags stories. The hallmark of a successful trader is his ability to accumulate equity. You need to make trading as objective as possible. Keep a diary of all your trades with before and after charts. Keep a spreadsheet listing all your trades, including commissions and slippage, and maintain very strict money management rules. You may have to devote as much energy to analyzing yourself as you do to analyzing the markets. When I was learning how to trade, I read every book on trading psychology I could find. Many writers offered sensible advice. Some stressed discipline. You cannot let the market sway you. Do not make decisions during trading hours. Plan a trade and trade a plan. Others stressed flexibility. Do not enter the market with any preconceived notions. Change your plans when markets change. Some experts suggested isolation. No business news, no Wall Street Journal, no listening to other traders, just you and the markets. Others advised being open-minded, keeping in touch with other traders, and soaking up fresh ideas. Each piece of advice seemed to make sense, but contradicted other equally sensible advice. As a trader, You are in the business of trading. You need to define your businessman's risk, the maximum amount of money you will risk on any single trade. There is no standard dollar amount, just as there is no standard business. An acceptable businessman's risk depends, first of all, on the size of your trading account. It also depends on your trading method and pain tolerance. The concept of a businessman's risk will change the way you manage your money. A sensible trader never risks more than 2% of account equity on any trade. For example, if you have $30,000 in your account, you may not risk more than $600 per trade, and if you have $10,000, you may not risk more than $200. If your account is small, limit yourself to trading less expensive markets or mini-contracts. If you see an attractive trade but your stop would have to be placed where more than 2% of equity would be at risk, pass that trade. Avoid risking more than 2% on a trade the way a recovering alcoholic avoids bars. If you are not sure how much to risk, err on the side of caution. If you blame excess commissions on a broker and slippage on a floor trader, you give up control of your trading life. Try to reduce both, but take responsibility for them. If you lose even $1 more than your businessman's risk, including commissions and slippage, you are a loser. Do you keep good trading records? Poor record-keeping is a sure sign of a gambler and a loser. Good businessmen keep good records. Your trading records must show the date and price of every entry and exit, slippage, commissions, stops, all adjustments of stops, reasons for entering, objectives for exiting, maximum paper profit, maximum paper loss after a stop was hit, and any other necessary data. If you bail out of a trade within your businessman's risk, it is normal business. There is no bargaining, no waiting for another tick, no hoping for a change. Losing $1 more than your established businessman's risk is like getting drunk, getting into a brawl, getting sick to your stomach on your way home, and waking up in the gutter with a headache. You would never want that to happen. Each trader has his own demons to exorcise on the journey to becoming a successful professional. Here are several rules that worked for me as I grew from a wild amateur into an erratic semi-professional, and finally into a professional trader. You may change this list to suit your personality. 1. Decide that you are in the market for the long haul. That is, you want to be a trader even 20 years from now. 2. Learn as much as you can. Read and listen to experts, but keep a degree of healthy skepticism about everything. Ask questions, and do not accept experts at their word. 3. Do not get greedy and rush to trade. Take your time to learn. The markets will be there with more good opportunities in the months and years ahead. 4. Develop a method for analyzing the market. That is, if A happens, then B is likely to happen. Markets have many dimensions. Use several analytic methods to confirm trades. Test everything on historical data, and then in the markets using real money. Markets keep changing. You need different tools for trading bull and bear markets and transitional periods, as well as a method for telling the difference. 5. Develop a money management plan. Your first goal must be long-term survival. Your second goal, a steady growth of capital. And your third goal, making high profits. Most traders put the third goal first, and are unaware that goals 1 and 2 exist. 6. Be aware that a trader is the weakest link in any trading system. Go to a meeting of Alcoholics Anonymous to learn how to avoid losses or develop your own method for cutting out impulsive trades. 7. Winners think, feel, and act differently than losers. You must look within yourself, Strip away your illusions and change your old ways of being, thinking, and acting. Change is hard, but if you want to be a professional trader, you have to work on changing your personality. Mass psychology. Wall Street is named after a wall that kept farm animals from wandering away from the settlement at the tip of Manhattan. The farming legacy lives on in the language of traders. 4 animals are mentioned especially often on Wall Street: bulls and bears, hogs and sheep. Traders say, bulls make money, bears make money, but hogs get slaughtered. A bull fights by striking up with his horns. A bull is a buyer, a person who bets on a rally and profits from a rise in prices. A bear fights by striking down with his paws. A bear is a seller, a person who bets on a decline and profits from a fall in prices. Hogs are greedy. They get slaughtered when they trade to satisfy their greed. Some hogs buy or sell positions that are too large for them and get destroyed by a small adverse move. Other hogs overstay their positions. They keep waiting for profits to get bigger even after the trend reverses. Sheep are passive and fearful followers of trends, tips, and gurus. They sometimes put on a bull's horns or a bearskin and try to swagger. You recognize them by their pitiful bleating when the market becomes volatile. Whenever the market is open, bulls are buying, bears are selling, hogs and sheep get trampled underfoot, and the undecided traders wait on the sidelines. Quote machines all over the world show a steady stream of quotes, the latest prices for any trading vehicle. Thousands of eyes are focused on each price quote as people make trading decisions. There are 3 groups of traders in the market: buyers, sellers, and undecided traders. Ask is what a seller asks for his merchandise. Bid is what a buyer offers for that merchandise. Buyers and sellers are always in conflict. Buyers want to pay as little as possible, and sellers want to charge as much as possible. If members of both groups insist on having their way, no trade can take place. No trade means no price, only wishful quotes of buyers and sellers. A seller has a choice: to wait until prices rise or to accept a lower offer for his merchandise. A buyer also has a choice: to wait until prices come down or to offer to pay more to the sellers. A trade occurs when there is a momentary meeting of 2 minds. An eager bull agrees to a seller's terms and pays up, or an eager bear agrees to a buyer's terms and sells a little cheaper. The presence of undecided traders puts pressure on both bulls and bears. When a buyer and a seller bargain in private, they may haggle at a leisurely pace. The 2 must move much faster when they bargain at the exchange. They know that they are surrounded by a crowd of other traders who may butt in on their deal at any moment. The buyer knows that if he thinks for too long, another trader can step in and snap away his bargain. A seller knows that if he tries to hold out for a higher price, another trader may step in and sell at a lower price. The crowd of undecided traders makes buyers and sellers more anxious to accommodate their opponents. A trade occurs when there is a meeting of 2 minds. Each tick on your quote screen represents a deal between a buyer and a seller. Buyers are buying because they expect prices to rise. Sellers are selling because they expect prices to fall. Buyers and sellers trade while surrounded by crowds of undecided traders. They may become buyers or sellers as prices change or as time passes. Buying by bulls pushes markets up. Selling by bears pushes markets down, and undecided traders make everything happen faster by creating a sense of urgency in buyers and sellers. Traders come to the markets from all over the world, in person, via computers, or through their brokers. Everybody has a chance to buy and to sell. Each price is a momentary consensus of value of all market participants expressed in action. Price is a psychological event. a momentary balance of opinion between bulls and bears. Prices are created by masses of traders, buyers, sellers, and undecided people. The patterns of prices and volume reflect the mass psychology of the markets. Huge crowds converge on stock, commodity, and option exchanges, either in person or represented by their brokers. Big money and little money, smart money and dumb money, institutional money and private money all meet on the exchange floor. Each price represents a momentary consensus of value between buyers, sellers, and undecided traders at the moment of transaction. There is a crowd of traders behind every pattern in the chart book. Crowd consensus changes from moment to moment. Sometimes it gets established in a very low-key environment, and at other times the environment turns wild. Prices move in small increments during quiet times. When a crowd becomes either spooked or elated, prices begin to jump. Imagine bidding for a life preserver aboard a sinking ship. That's how prices leap when masses of traders become emotional about a trend. An astute trader tries to enter the market during quiet times and take profits during wild times. Technical analysts study swings of mass psychology in the financial markets. Each trading session is a battle between bulls, who make money when prices rise, and bears, who profit when prices fall. The goal of technical analysts is to discover the balance of power between bulls and bears and bet on the winning group. If bulls are much stronger, you should buy and hold. If bears are much stronger, you should sell and sell short. If both camps are about equal in strength, a wise trader stands aside. He lets bullies fight with each other and puts on a trade only when he is reasonably sure who is likely to win. Prices, volume, and open interest reflect crowd behavior. So do the indicators that are based on them. This makes technical analysis similar to poll-taking. Both combine science and art. They are scientific to the extent that we use statistical methods in computers. They are artistic to the extent that we use personal judgment to interpret our findings. What is the reality behind market symbols, prices, numbers, and graphs? When you check prices in your newspaper, watch quotes on your screen, or plot an indicator on your chart, what exactly are you looking at? What is the market that you want to analyze and trade? Amateurs act as if the market is a giant happening, a ball game in which they can join the professionals and make money. Traders from a scientific or engineering background often treat the market as a physical event. They apply to it the principles of signal processing, noise reduction, and similar ideas. By contrast, all professional traders know full well what the market is. It is a huge mass of people. Every trader tries to take money away from other traders by outguessing them on the probable direction of the market. The members of the market crowd live on different continents. They are united by modern telecommunications in the pursuit of profit at each other's expense. The market is a huge crowd of people. Each member of the crowd tries to take money away from other members by outsmarting them. The market is a uniquely harsh environment because everyone is against you and you are against everyone. Not only is the market harsh, you have to pay high prices for entering and exiting it. You have to jump over 2 high barriers, commissions and slippage, before you can collect a dime. The moment you place an order, you owe your broker a commission. You are behind the game before you begin. Then floor traders try to hit you with slippage when your order arrives on the floor. They try to take another bite out of your account when you exit your trade. In trading, you compete against some of the brightest minds in the world while fending off the piranhas of commissions and slippage. Private traders usually come to the market after a successful career in business or in the professions. An average private futures trader in the United States is a 50-year-old, married, college-educated man. Many futures traders own their own businesses, and many have postgraduate degrees. The two largest occupational groups among futures traders are farmers and engineers. Most people trade for partly rational, partly irrational reasons. Rational reasons include the desire to earn a large return on capital. Irrational reasons include gambling and a search for excitement. Most traders are not aware of their irrational motives. Learning to trade takes hard work, time, energy, and money. Few individuals rise to the level of professionals who can support themselves by trading. Professionals are extremely serious about what they do. They satisfy their irrational goals outside the markets, while amateurs act them out in the marketplace. The major economic role of a trader is to support his broker, to help him pay his mortgage and keep his children in private schools. In addition, the role of a speculator is to help companies raise capital in the stock market and to assume a price risk in the commodities markets, allowing producers to focus on production. These lofty economic goals are far from a speculator's mind when he gives an order to his broker. Institutions are responsible for a huge volume of trading. Their deep pockets give them several advantages. They pay low institutional commissions. They can afford to hire the best researchers, brokers, and traders. Some even strike back at floor traders who steal too much in slippage. The spate of arrests and trials of Chicago floor traders in 1990 and 1991 began when Archer Daniels Midland, a food processing firm, brought in the FBI. A friend of mine who heads a trading desk at a bank bases some of his decisions on a service provided by a group of former CIA officers. They scan the media to detect early trends in society and send their reports to him. My trader friend culls some of his best ideas from these reports. The substantial annual fee for those experts is small potatoes for his firm compared with the millions of dollars it trades. Most private traders do not have such opportunities. It is easier for institutions to buy the best research. An acquaintance who used to trade successfully for a Wall Street investment bank found himself in trouble when he quit to trade for himself. He discovered that a real-time quote system in his Park Avenue apartment in Manhattan did not give him news as fast as the squawk box on the trading floor of his old firm. Brokers from around the country used to call him with the latest ideas because they wanted his orders. "When you trade from your house, you are never the first to hear the news," he says. Some large firms have intelligence networks that enable them to act before the public. One day, when oil futures rallied in response to a fire on a platform in the North Sea, I called a friend at an oil firm. The market was frantic, but he was relaxed. He had bought oil futures half an hour before they exploded. He had gotten a telex from an agent in the area of the fire well before the reports appeared on the newswire. Timely information is priceless, but only a large company can afford an intelligence network. The firms that deal in both futures and cash markets have two advantages. They have true inside information, and they are exempt from speculative position limits. airport, I walked through glass-enclosed corridors. Clusters of men huddled around monitors trading oil products. When I asked my host whether his traders were hedging or speculating, he looked me straight in the eye and said, "Yes." I asked again and received the same answer. Companies crisscross the thin line between hedging and speculating based on inside information. Employees of trading firms have a psychological advantage. They can be more relaxed because their own money is not at risk. Most individuals do not have the discipline to stop trading when they get on a losing streak, but institutions impose discipline on traders. A trader is given two limits: how much he may risk on a single trade, and the maximum amount he may lose in a month. These limits work as stop-loss orders on a trader. With all these advantages, how can an individual trader compete against institutions and win? First, many institutional trading departments are poorly run. Second, the Achilles heel of most institutions is that they often have to trade, while an individual trader is free to trade or stay out of the market. Banks have to be active in the bond market, and food processing companies have to be active in the grain market at